Some traders swear Fibonacci levels control the market. Others say they're just random lines people draw after the fact. So which is it? Does Fibonacci actually work in today's market? Or are traders just convincing themselves price reacted there? Today we're breaking down the truth. And I'm going to show you exactly when Fibonacci levels actually work and when it completely fails. This is episode 5 of What Works in Today's Market, where we test popular trading indicators and see if it still gives traders an edge. We've already covered moving averages, RSI, VWAP, and the MACD. Now it's time to talk about one of the most debated tools in trading, Fibonacci Retracements. Now, before we get started, this video is for educational purposes only. I am not a financial advisor, and you should definitely trade at your own risk. Now, what really is the Fibonacci? Fibonacci retracements are simple percentage-based pullback levels. The most commonly watched levels are the 38.2%, 50%, 61.8%. They measure how much of a prior move price has retraced. That's it. They don't predict price. They don't force reactions. They simply mark areas where traders expect pullbacks to slow down. These setups are everywhere. Any strong breakout, any clear trend day, any obvious swing high or swing low. You don't need rare examples, you just need clean structures. The biggest mistake traders make with Fibonacci is they draw it everywhere. Every tiny swing, every minor pullback, every 5-minute fluctuation. That turns Fibonacci into noise. Fibonacci works best on clear, obvious impulse moves, not micro chop. If you have to squint to find the swing, that's probably not the one to measure. Now, when does Fibonacci work? Fibonacci works best when there's a clear impulse move, strong directional push, not sideways chop, not slow drift, a real expansion move. 2, it aligns with structure. At 61.8 retracement that lines up with prior support or resistance is far stronger than a random Fibonacci level floating in space. Structure gives the level meaning. 3, momentum confirms it. If RSI resets during a pullback or MACD contracts into the retracement, that's confluence. Fibonacci alone is weak. Fibonacci with structure and momentum is powerful. Now here's how professional traders think about it. 38.2%, strong trend pullback. 50%, balanced retracement. 61.8, deep pullback but trend still intact. If price blows through 61.8 with strong momentum, that trend might not be as strong as you thought. Now, when does the Fibonacci fail? Fibonacci fails when the market is choppy, there's no real impulse, you force levels onto small swings, you ignore overall trend direction. In range-bound conditions, Fibonacci becomes random noise. Context matters more than the level. So does the Fibonacci still work? Yes, the Fibonacci still works in today's market, but not because of magic numbers. It works because markets move in impulse and corrections. It works because traders and algorithms are all watching the same pullback percentages. It works as a measuring tool, not a prediction tool. Fibonacci isn't magic. It's just a way to measure how much of a move the market has given back. Use it alone and it's weak. Use it with structure, momentum, VWAP and context, and it becomes powerful. But measuring pullbacks is only part of the equation. In the next episode of What Works in Today's Markets, we're breaking down another indicator that traders constantly misunderstand, Bollinger Bands. Most traders think touching the top band means sell and touching the bottom band means buy. But that's not what Bollinger Bands were designed to show. So do Bollinger Bands still work in today's market? Or are traders fading trends they should be riding? We're breaking that down next. So if this breakdown helped you see Fibonacci differently, make sure to like the video and subscribe so you don't miss the next episode. This is XViper TV. Thanks for watching and happy trading.